Welcome back to the Daily Crypto Roundup. And today, we've got a seriously important mix of stories that you need to understand, because this isn't just about price action anymore. This is about where crypto is heading next, how it's being shaped by global politics, how security risks are evolving, and how entirely new sectors are exploding almost overnight. We're going to break down why Bitcoin suddenly reversed course alongside global markets after a geopolitical scare involving Iran, why a $270 million exploit on Solana wasn't actually a hack in the traditional sense, but something much deeper, why Vitalik Buterin is now warning that artificial intelligence could become one of the biggest threats to your personal security, and finally, why prediction markets just pulled in nearly $2 billion in volume and could be the next major wave in crypto adoption. So let's start with the market itself, because this sets the tone for everything else. Bitcoin saw a sharp move lower earlier in the day, and if you were watching closely, it didn't feel like a normal crypto sell-off. This wasn't driven by ETF outflows, it wasn't driven by on-chain data, and it wasn't driven by any specific crypto catalyst. Instead, it was driven by macro fear, specifically rising tension in the Middle East and concerns around key oil shipping routes. Now, when geopolitical risk rises, especially around something like the Strait of Hormuz, which is one of the most important oil choke points in the world, markets immediately start pricing in disruption. If oil supply is threatened, oil prices spike, inflation expectations rise, and risk assets tend to sell off. That includes stocks, and increasingly, that includes crypto as well. And that's exactly what we saw. Stocks dropped, Bitcoin dropped, and the market moved into a risk-off mode very quickly. But then something changed. Reports came out that Iran was signaling cooperation regarding shipping routes, specifically working with regional partners to ensure stability and avoid disruption. That single headline was enough to completely shift sentiment. Oil fears eased, markets stabilized, and what we saw next was a rapid reversal. Stocks erased their earlier losses, and Bitcoin trimmed a significant portion of its decline. But here's the important detail, and this is where you need to pay attention. Bitcoin didn't fully recover. It bounced, but it didn't reclaim strength in the same way equities did. And that tells you something very important about the current state of the market. Crypto right now is not acting like a safe haven. It's acting like a high-risk asset that is still dependent on broader macro sentiment. That means when fear enters the system, Bitcoin drops alongside everything else. And when relief comes in, it recovers, but not with conviction. This is a market that is extremely reactive to headlines. One piece of news can cause a sharp sell-off, and another can reverse it just as quickly. That tells you positioning is weak. Confidence is fragile, and traders are not anchored to long-term conviction right now. They are reacting in real time. And that's something you need to understand going forward because it means volatility is not going away anytime soon. Now let's move into what is probably the most important structural story of the day, and that is the $270 million exploit involving Drift Protocol on Solana. At first glance, you might think this is just another hack, another example of funds being drained, another security failure in DeFi. But this one is different, and the reason it's different is because it wasn't really a hack in the traditional sense. This was an exploit of a feature, and that distinction matters. The issue revolves around how Solana-based applications are designed, particularly when it comes to user experience. Solana has always prioritized speed, efficiency, and ease of use. Transactions are fast, fees are low, and applications are built to reduce friction as much as possible. One of the ways they do that is by allowing delegated authority. In simple terms, this means that users can grant permission to a program or smart contract to act on their behalf. This allows for things like automated trading, faster execution, and a smoother overall experience. But here's the problem. When you introduce convenience, you introduce risk. What the attacker managed to do was exploit this delegated authority system, either by gaining access to permissions or mimicking them in a way that allowed them to execute transactions they shouldn't have been able to. Once inside that system, they were able to move funds quickly and efficiently, draining a massive amount of value in a very short period of time. And because Solana is designed for speed, there was very little friction to slow this down. This is not about a broken contract. It's about a flawed permission model. It's the equivalent of giving someone access to your account for convenience and then realizing that access was far more powerful than you intended. And this brings us to a much bigger conversation about the direction of crypto. There are two competing philosophies right now. On one side, you have systems that prioritize user experience, speed, and accessibility. Fewer clicks, faster execution, less friction. On the other side, you have systems that prioritize security, verification, and control. More steps, more confirmations, slower processes, but stronger safeguards. This exploit strengthens the argument that friction is not a bug. It's a feature. Because every layer of convenience removes a layer of protection. And what makes this even more concerning is that most users don't fully understand what they are approving when they interact with these systems. They click through permissions, they authorize actions, and they trust that the system is secure. But in reality, they may be granting far more access than they realize. This is a major issue for the entire industry, not just Solana. Because as crypto becomes easier to use, it also becomes easier to exploit. Now let's take this a step further, because this next story connects directly to that theme of security, but from a completely different angle. Vitalik Buterin has come out with a warning about artificial intelligence, and this is not just a casual comment. This is a serious concern about how AI is evolving and what it means for personal security. His main argument is that current AI systems are too centralized. Most of the AI tools people are using today rely on cloud-based infrastructure. That means your data, your inputs, your conversations, and potentially even sensitive personal information are being processed on external servers. And his concern is simple. You are handing over your digital life to systems you do not control. Now, on its own, that might not sound alarming. But when you combine that with the rise of AI agents, systems that can act autonomously, execute tasks, and interact with other systems, the risk increases significantly. These are not just passive tools anymore, they are active participants. And that opens the door to a whole new category of threats. AI systems could potentially execute actions without explicit approval, modify settings, access sensitive data, or even communicate externally in ways that are not immediately visible to the user. There are already reports suggesting that a portion of AI tools and agent systems contain hidden or malicious instructions. That means users could be interacting with systems that are not fully aligned with their interests. And here's where Vitalik's solution comes in. He is pushing for what he calls local-first AI. This means running AI models directly on your own device, keeping data stored locally, and minimizing reliance on external servers. It also involves sandboxing AI systems, limiting their access to critical functions, and requiring human confirmation for important actions. If this sounds familiar, it should, because it mirrors the core principles of crypto. Self-custody, control, trust minimization. In crypto, the idea is simple. If you don't control your keys, you don't control your assets. Vitalik is now applying that same logic to AI. If you don't control the system, you don't control your data. And this is where things get really interesting, because it shows how these two worlds are starting to merge. AI is going to interact with crypto. It's going to manage wallets, execute trades, and make decisions. And if those systems are not secure, the consequences could be significant. This is not a future problem. This is something that is already starting to take shape. Now let's move into the final story, because this one represents a completely different kind of shift. Prediction markets. YZI Labs has doubled down on predict.fun after the platform saw around $1.8 billion in trading volume. And that number is not small. This is not a niche experiment anymore. This is a rapidly growing sector that is attracting real attention and real capital. Prediction markets allow users to trade on outcomes, not just asset prices, but events, narratives, and real-world developments. Politics, crypto movements, global events. Instead of simply investing in a token and waiting for it to go up, users are actively placing positions on what they think will happen next. And that changes everything, because it turns attention into something that can be monetized directly. Instead of consuming information passively, users are engaging with it financially. They are making decisions, taking positions, and reacting to news in real time. This creates a feedback loop. More engagement leads to more volume. More volume leads to more liquidity. More liquidity attracts more users, and that's how you get to billions in volume very quickly. But it also introduces risk, because at its core, this is very similar to gambling. High-frequency decisions, emotional reactions, and rapid changes in sentiment can lead to significant volatility. Regulation is also going to be a major factor here. Prediction markets sit in a gray area between finance and betting, and that is something regulators are already paying attention to. So while this sector has massive potential, it also comes with uncertainty. But here's the bigger picture. We are moving toward a world where everything becomes a market. Not just assets, but ideas, events, and outcomes. And crypto is the infrastructure that makes that possible. So when you step back and look at all of these stories together, a pattern starts to emerge. Markets are being driven by global events. Security risks are evolving as systems become more complex. AI is introducing new layers of risk and opportunity. And entirely new sectors are forming that change how people interact with information and value. This is not a static industry. It is evolving rapidly, and the pace of change is accelerating. And that means the edge is not just in understanding what is happening. It's in understanding why it's happening and where it's going next. Because the people who can connect these dots early are the ones who position themselves ahead of the curve. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.